Let's break down this long put option quote. Long won XYZ Jan 80 put at 7. One of the more important aspects of options is understanding its language. So by the end of this video, let's make sure we're crystal clear on what this option quote is telling us. First, the word long, which can actually relate to a few different things. In general, long refers to ownership, or more simply, the fact that an investor that is long this option purchased this option. When an investor purchases an option, they gain a right to do something. And that's a key point with options. When you purchase an option, you always gain a right. We will discuss more about that right later in this video. Investors purchase option contracts in specific numbers, and in particular, this quote has one option contract involved. Each option contract covers 100 shares of stock. Therefore, this option contract has control over 100 shares of XYZ stock. XYZ is a made-up fictitious company just for purposes of this made-up options quote. In the real world, you'll find options on many different publicly traded companies like Walmart, Apple, and Tesla. So for example, if this was a Walmart option, this option would have control over 100 shares of Walmart stock. Most option questions you'll come across involve fictitious companies like ABC or XYZ, mostly to make sure that the question is phrased in a general manner. Each option will also have an expiration month, which refers to the end of the option. Options typically expire on the third Friday of the month at 11:59 p.m. So we can safely assume that this option will expire on the third Friday in January at 11:59 p.m. Expiration is important because options have something called time value, which we'll visit later in this video. This is a long put option, and long put options provide the right to sell the underlying stock at the strike price. XYZ is the underlying stock, and $80 is the strike price. The investor with the long put will have the right to sell 100 shares of XYZ stock at $80 per share. The benefit of an option is always in comparison to the market. If the option provides a better transaction price than, say, what the market would offer, then the option has something that we call intrinsic value. Let's assume the market price of XYZ stock is currently at $78 per share. The long put provides the right to sell the stock at $80, which is $2 better than what the market's offering. If the investor obtained this option completely for free somehow, they could go to the market, buy 100 shares of XYZ stock at $78 per share, and then exercise the put and sell those 100 shares at $80 per share, making a $2 per share or overall $200 profit when they do so. Going back to time value, that's why more time is more valuable on an option. While XYZ stock's market price might be at $78 today, it could decline considerably in value in the future. And the lower the market price goes, the bigger the profit. So as an example, let's say the market price goes all the way down to $10 per share. Well, at that price, this option is actually very valuable. An investor could go to the market, buy 100 shares of XYZ stock at $10 a share, and then immediately exercise the put and sell those shares for $80 per share. And yes, in case you're wondering, this option has $70 of intrinsic value on a per share basis. Bottom line, more time means more opportunity for the market price to decline further and for the option to gain more and more intrinsic value. The more the market price falls, the better the benefit of the option. The last piece of this quote is the premium, which is the $7 in the quote. Now, the quote is provided on a per share basis, so this is actually going to cost $700 if an investor decides to purchase this option. Nothing is free in finance, and neither is the right to lock in a sale price of a stock for a set period of time. The thing we have to keep in mind is that whenever someone purchases an option, there's actually another investor on the other side that's selling that option. That selling investor is providing the person that's buying the option a right. Think about it. If I gave you the right to sell 100 shares of stock to me for 80, that means that I have the obligation to buy that stock from you at 80 should you exercise your right. The buyer pays the premium for the right they receive, and the seller receives the premium for the obligation they put themselves into. And that's the game of options. Basically, two investors betting on where stock prices will go in the future. The premium can be further broken down into two components that we've already discussed at length and we'll go further into, that being intrinsic value and time value. As we've learned, the intrinsic value of an option reflects its current exercise value. So again, let's assume that the market price is $78, and of course at $78, the option has $2 of intrinsic value because it provides a better transaction price by $2. Determining an option's intrinsic value can sometimes be important on financial exams, and there's actually an easy way to figure that out, and that's through the saying, call up, put down. Now we have a put here, so we'll be focusing on the put down part of it. When the market price falls below the strike price of a put, then the put has intrinsic value, put down. And the further it goes down, the more intrinsic value it gains. If the market price were to go above the strike price, the option has no intrinsic value. So for example, if the market price went to 90, would you ever want to exercise your rights with this option and sell the stock at 80 when you could just go to the market and sell the same stock for 90? No, wouldn't be a good idea. So let's reset and again assume the market price is 78 and that we've got $2 of intrinsic value involved currently with this option. Now, once we have an option's premium and its intrinsic value, we can actually calculate the time value of the option using a little bit of algebra. If the option premium is $7 and the intrinsic value is $2, well, that must mean that the time value is $5. Breaking down the option this way really helps an investor understand what they're buying when they purchase an option, especially a more expensive option like a $700 option. $2 per share or $200 overall is paying for the immediate intrinsic value that this option already provides. The other $5 per share or $500 overall is paying for time in hopes that the market price continues to decline further. If this option were to have a longer expiration, it would absolutely have a higher premium. For example, if we compared the January 80 put to say a February 80 put, the 80 put would have a higher premium just because of the additional time value. Let's say that the February 80 put has a premium of 9. Comparing the two options, the February option also has $2 of intrinsic value when the market price is at 78. It's exactly the same as the January option from an intrinsic value standpoint. However, the February option will be more expensive because of the additional time associated with it. With a premium of $9, that means that the February option has $7 of time value, which is $2 more of time value than the January option. And that is to be expected. Now, just so you know, premiums fluctuate on a daily basis just like stock prices. Supply and demand determines premiums, and more valuable options will have more demand associated with them and therefore result in a higher premium. We're getting towards the end here, so let's go ahead and summarize everything we've already talked about. This is a long option, which means that the investor purchased this option. Long puts provide the right to sell 100 shares of the underlying stock at the strike price per contract. The underlying stock is XYZ stock, and the strike price is $80 per share. The option expires on the third Friday of January at 11:59 p.m. Eastern. The premium reflects the cost of the contract on a per share basis, so this is actually going to cost $700 if an investor decides to purchase this option. Hi, I'm Brandon. If you enjoyed this video, then you'll love the courses I authored with Achievable. They include tons of real-world examples, more videos just like these on dozens of key topics, a built-in study planner, hundreds of chapter review questions, and unlimited practice exams. Our courses are competitively priced, and you can try them out for free first to see if our style is the right fit for you. Follow the links below in the description to get started.